Hey guys, I'm just going to be going over the EURUSD call that I put out in the TPM and Discord last week. You can see there it was last week on Sunday, January the 28th. I put the call out for EURUSD to be getting some D15 longs, and then at the end of the week, a weekly 1 hour short. I'm going to hop onto the charts now and show you the breakdown for that call and how it went. So that is the weekly candle in question. When I gave the call for this point in time, this candle had only closed. So this candle had not yet printed. It was still waiting to open the following week. So I was saying that it was going to be a weekly 1 hour short, which you can see that it was because the candle closed bearish now at the end of this week. But I'm just going to move over to the daily time frame, because I did say that the daily was going to long into that short. And usually with the rules, I always say the higher time frame, if you're below the 8 EMA, you're shorting. If you're above, you're looking for longs, except for when you've already taken profit on that time frame. So I'll address that now, how you can see a potential reversal point. You can see the daily's been below, a little bit of consolidation, but below again the 8 EMA for quite some time now. So the take profit points on a D15 entry, a D15 short entries in this case, it would be either a 1 hour anchored wave or a 4 hour anchored wave is the take profit 2. I'll just go show you the 4 hour. If we had been shorting the daily from this point, we would have already taken profit, and it looks like there's a second potential take profit point on the 4 hour. And then we are starting to come back out of that oversold area, and we're getting the bullish divergence, which means there can potentially be a reversal, which there was. So from that point, when you're coming out of the oversold level on your take profit 2 time frame, I'm starting to say that we can potentially be getting a reversal, and you can see that happened on about Monday going into Tuesday. So that's why I was saying that we could be getting D15 longs into a weekly 1 hour short, even though the daily was still under the 8 EMA. Once you hit your take profit 2, you really have to think that a reversal could be coming in. I mean, you can just keep on going with the trend until it ends, but you can see that there's not always going to be red candles in a downtrend. So if you're looking for D15 shorts all the way, it's probably about a 50% win rate, 50% hit rate in terms of actually even getting the directional bias correct every day. It looks like alternate days you were getting longs and shorts on the D15, even though it was under the 8 EMA. So using the take profit point as a potential reversal is very helpful. And in this case, it was very accurate. So I'm going to show you the D15 longs into the weekly 1 hour short for the call that I gave in the Discord last week. Okay, so I've just marked the start of each day last week. You can see they're starting Monday, and then it was Tuesday, Wednesday, Thursday, Friday. Last week was a very good week in terms of the calls in the Discord. We had nearly an entry every single day, which is usually not the case. Usually with a D15 setup, you're probably going to get entries maybe once or twice per week, and then obviously with the weekly 1 hour, you have one chance per week to get that, but you're not going to always get it. With this, on the 15-minute time frame, this is the criteria that we're looking at. Now that we have our bias for the higher time frame daily candle, essentially we want to use the 15-minute oversold areas. That's the waves below this red line, which is -60 on the wave trend indicator. We're using the oversold levels to catch the bottom wick on a daily candle, and then we want to ride that into profit. So the conditions are the 15-minute needs to be below the daily open price, and then the 15-minute wave has to hit the oversold level. Sometimes it'll be clean, hitting the oversold level and then coming back, but other times you're going to have a regular divergence. And we have 2 of each in the case that I'm going to show you now. And then the 15-minute candle has to body close above the 8 EMA, and that is the confirmation for your entry. Starting on Monday, you might have been stopped out once over here. If you're using this oversold wave and then getting the body close above the 8 EMA just there, that was a stop out, and potentially even a second stop out here if you weren't waiting for the divergence, right? When the divergence was in, that was the actual entry. Bearing in mind that it is a divergence usually is the only thing that's going to stop you out. If your directional bias is correct and you get stopped out of a trade, you're getting stopped out by a regular divergence. But don't forget that a regular divergence is a reversal indication. So it means if you are coming down and you're getting that divergence that would have stopped you out initially on the first entry, it means that now price is ready to reverse, and that is the actual entry to go long. Okay, so that was Monday, maybe 2 stop outs and then 1 entry. You could have swung that. You could have either swung it to the next day here or even there. It would have still been safe then going into Thursday as well. On Tuesday, you had the clean entry where there was no divergence. If you had entered right away on the break back of the oversold level and the bullish close above the EMA, that was safe the whole time. No divergence to stop you out. And then on the Wednesday, you had the divergence again. So you potentially could have been stopped out over here if you'd swung those lows. And again, it is a divergence that can stop you out, which is an indication that price is reversing. If your directional bias is correct, that is your actual entry. And then on Thursday, we had another clean entry. There was no divergence off this wave, broke back on the oversold level, and then you had the body closing above the EMA. And then we went into Friday, and the non-farm payrolls ended up giving us our weekly 1 hour short position. What I first want to show you is that it is the oversold level on the 15-minute that is catching the bottom wick on the daily candle. Say for those two stop outs, so you can say you got, let's just count them, right? So you've been stopped out once, twice, and let's say 3 times. I just want to see anyhow if, let's just say you just went from oversold to overbought divergence, what we would have gotten. So this almost negates those losses, so 2.5. So maybe you end up only with a 0.5. This one and this one, let's just say it was a 4. Not sure where you would have gotten out, but it would have only been a 3 because you got stopped out once. And then this one as well, if you just went there and didn't wait for the divergence to print, is a 5. So let's just say 5, 3, 2, and a half. So 10.5, yeah? So what you can either do is, in that case, you can, if you want to, only play moves where there is a divergence. If that is the case, on this one, you still might have been stopped out. You would have still lost this trade, showing you a divergence there, but then you would have entered this one and been safe, and then you wouldn't have gotten this entry. You wouldn't have gotten this entry, but then you wouldn't have been stopped out there either, right? So then your R goes from 10.5 to a 4, let's just say -1 over here, so a 5.5, right? I know a lot of people only wait for the divergences to print. I know it's painful to have a divergence stop out, but remember what I said. If you are getting a regular divergence that is stopping you out and you are confident that you are with trend, then that regular divergence stop out means that now it is the correct move, because regular divergence is an indication that price is reversing. So don't forget that. What I'm going to do is I'm just going to mark up the correct entry on each one of these to show you that it is the bottom wick on the daily candle that this oversold level on the 15-minute time frame is catching. All right, so we're on the daily time frame and I'm just zooming in so we can see the bottom wicks on these daily candles. That was our Monday long entry. And then Tuesday, if you were holding Tuesday as a swing trade, then you would have been stopped out on Wednesday. But Wednesday, again, you can see you're catching the wick. And then Thursday, the wick was absolute perfection. I mean, that was great. I would say, yeah, Monday and Thursday were probably your best. Thursday was not a divergence entry. Monday was. So who's to say which is better? You never know what the size of the higher time frame candle is going to be before it occurs. So yeah, I would enter both types of entries. Even if I got stopped out by a divergence, I'd still be happy to enter, because you never know if the divergence is going to print or not. And you can see that even being stopped out by the divergence entry, it still yields a net positive result. So for me, it's worthwhile to still play the confirmation, play your edge, and your edge will win over time. It is, again, probabilities, and we have to let the probabilities play out without using too much judgment or interference. As far as the rules go for the weekly 1 hour short position, the weekly candle was below the AEMA, so the bias was short for that one. You haven't hit the take profit for the weekly 1 hour yet on the second take profit time frame, but you can see here that we were starting to get the overbought level, which was also going to be a regular divergence. The thing is with this one, you didn't really get, I mean, maybe that was a body close under the AEMA. Doesn't look perfect. I don't know how it looked at the time because I was asleep, 11 p.m. So that's coming into, obviously that's non-farm payrolls, that massive push there. So I don't know how easy that would have been for someone to catch. I mean, if you had caught it and swung the high, you would have been safe for non-farm payrolls. Absolutely not encouraging any person to trade the news, of course, especially not high impact news, but that would have been your weekly 1 hour short. You would again have to have waited for the divergence, or not even in this case, because when you got the overbought level, plus 60 here, there was no red candle body closing down on the AEMA until the divergence was created. So in this case, in a way, you were forced to wait for the regular divergence to be in before the move was validated, right? Because you need step 1, 2, and 3 to occur. Price above the weekly open, hitting overbought, and then a red candle body closing under the 8 EMA. So in this case, that just so happened to be a regular divergence. So I'll show you where that condition is met. I'm just going to delete this. I'm going to delete that. All right, so I want to show you that this is the top wick on the weekly candle, which is what we're trying to catch. I'm just going to zoom in quickly so you can see that weekly candle. So that's it. The overbought level on the 1 hour time frame was catching the top wick on the weekly candle, and you're just riding it to the close or to the take profit area, which is either a 4 hour oversold anchor or a daily oversold anchor. So let's go see if either of those have hit. So it's still coming down for those. All right, so we are getting to the take profit 2 level then on the weekly 1 hour shorts. If the daily is going into the oversold level, you would be thinking about exiting your weekly 1 hour shorts. So that's it, guys. I just wanted to show you the difference between waiting to enter on a divergence or entering every confirmed condition, whether you know that it's a divergence or not yet, to show you the potential difference in what you can gain, both on net positive. It's up to your risk management and how you cope with loss aversion. But let me know in the comments below if you have any questions. Thanks, guys.